Hello everyone, I'm Mike Hengehold. Today is February 22nd, and there's an inflation topic that's been on my mind that I just wanted to talk about with you for a few minutes. So inflation has been demonstrating a very concerning amount of staying power lately. We continue to experience tight labor and service markets, and what's happening is this is resulting in stickier inflation, which the Fed has vowed to fight. Now, to be fair, inflation has cooled a bit from its highs that we saw last year, and that's, of course, been in the news a lot of cheering going on when we see CPI numbers coming out lower. But the reality is that peeling away of the first layer of inflation was the easy part. It kind of evaporated naturally as goods and gas prices fell with the resolution of the supply chain problems that followed the pandemic. But the thing is, supply chains only recover once. We don't get a second bite at that apple. The deeper and more entrenched layers of inflation will be harder to get rid of because they're related to rising wages and the increasing cost of services. Now, the reason we are focused like a laser beam on these two areas is because Jerome Powell recently said that core services which exclude housing, and that's important because housing sort of marches to its own drummer. So core services which exclude housing may be the most important category for understanding the future evolution of core inflation. So there it is. The chairman of the Federal Reserve is telling us exactly what we need to pay attention to. So where do we stand with these two items, the issue of labor and services? Well, as you can see from the chart, in January, employment surged with more than 500,000 jobs being added. Also, the unemployment rate dropped to an incredibly low 3.4%. To find a lower rate of unemployment, you'd have to go all the way back to 1953. So it's a historical number, really, from that perspective. It's also interesting when you look at the chart to see that the unemployment rate seems to trough just before recessions begin. That's relevant. We're going to talk about the possibility of recessions in a minute. Also, if we go back to the first chart, you can see that the U.S. services segment of the economy, as measured by the Institute of Supply Management, came in above expectations with an expansionary reading of 55.2. So, both of these key sources of inflation that Jerome Powell has told us that they're watching very acutely are showing pricing pressure. But you might ask, hasn't the Fed been hiking interest rates for nearly a year so we wouldn't have to fight these problems? And the answer is yes, but because of the lagged effect of Fed policy, their actions take a long time to kick in. Their initial actions have really just started to bite, and their more recent moves may still take several months to have a material impact. So how and when will the markets react? That's obviously something that's important to us. Well, markets are notoriously impossible to time. However, if the Fed continues to apply pressure to short-term interest rates because of these problems with services and wages, if that happens as the rest of the economy is slowing, then stocks will eventually prove to be overpriced and they'll experience a correction. Further, the bond market's current inversion, which means that short-term rates are higher than long-term rates, which isn't a situation that should exist in the natural world. That's likely predicting a slower economy in the future and potentially a recession sometime in the next year or so. And that means that bonds should do pretty well. They typically do well during times of financial stress. Assuming that's the case, we would expect the stock market to bottom before the economy ebbs, and until the economic slowdown arrives and inflation begins to recede, especially in those areas of wages and services, we would expect the markets to maintain their manic depressive behavior, and we expect the Fed to keep the pressure on. That's all for today, everybody. Thanks for watching. Bye-bye.